Hello and welcome back to Chapter 10 Notes. And so in this lecture video, this will be the last lecture video for Chapter 10. So it's going to finish covering flexible budgets and some concluding remarks as well. Okay, so let's look at this first practice problem. So this one is going to develop a flexible budget performance report, okay, using our contribution margin format, which we don't have up here. So the contribution margin format would be our sales, less our variable cost gives us our contribution margin, and then less our fixed cost gives us our net operating income. Net operating income is the same as income from operations, okay? This format is our external financial reporting format. So you see over here, let's take a look. Thomas Company provides the following fixed budget data for the year. Sales at 20,000 units, here's their total sales, and their costs, and then their income from operations. But they actually did 21,000 units, okay? And then here's their income from operations, sales, and expenses. You can see they made more money than what they thought. So on the surface, this looks pretty good. You know, we thought we were going to make $48,000, but we ended up making $49,500, and that's a positive thing. But what you can see is the budget was done for 20,000 units. So really what we want to do is redo this budget at 21,000 units and compare it against actual. Because what that's going to tell us is, yeah, you know what, you did better than what you said, but really you could have done even better if you had controlled your costs more effectively. Okay, and that's what we're going to see. So the first thing that we actually have to do is we have to put everything on a unit basis. All the variable costs, and then the sales price we need to do on a unit basis. So we sold 20,000 units. We divide that by 600,000. We sold each unit for $30, right? And we come over here and we say, okay, we sold 20,000 units. And our direct materials cost for those 20,000 units was $200,000. So you take the 200,000 divided by the 20,000, and then that gives you the direct materials cost per unit. You do the same thing over here. 160 divided by the 20,000 gives you the direct labor cost per unit. Over here, you would take your variable overhead, 60,000 divided by the 20,000. That would give you $3 of variable overhead per unit. Fixed overhead, we don't need to do that with. We just need to do the variable portions, okay? So go ahead and finish that out. Put everything, all the variable costs on a unit basis, just like what I did with price, and just like what I walked through, this as well, the 40,000 divided by the 20,000 gives you $2 of variable operating expenses per unit. Then what I want to do is we're going to set up a little chart. This will be our kind of mimic our performance report. We're going to come over here on the next page and we'll say budget, and then we'll say actual, and then we'll say variance. Okay? And we'll say line item over here. Okay? And we'll say our line item, remember our units, we'll start off with our units, and we're going to redo the budget at 21,000 units. Actuals at 21, so no variance. Okay? Then we'll come over here and we'll say sales. Now, what would sales be? What should sales have been? Let me ask it that way. What should sales have been if we sold 21,000 units? Well, we said the price per unit is 30. We would take 30 times 21,000 units, and then that would give us $630,000 in sales. And then what we do is we had actual sales equal to 651. Then we subtract the two, and we get $21,000. Now, actual sales are higher than what they should have been. That is a good thing. That's favorable, after favorable. And then we can come over here, and we can say our variable costs, VC. I'm running out of room, so I'll just have to say variable costs, and I'll say my direct materials, my direct labor, my variable manufacturing overhead, and then my variable operating expenses. Okay? So, my variable expenses, my direct materials, I have $200,000 at 20,000 the 20,000 units. Remember, we took 200,000 divided by 20,000, and we took that number times 21,000, okay, which gives us a direct materials cost of 210. Okay, 210,000, and then I look at our actual direct materials costs of 231, and what we have is $21,000. And is that favorable or unfavorable? Well, it's unfavorable because actual costs are higher than budget. Then we do the same thing for direct labor. We put our direct labor of 160 divided by our 20,000, take that number times $21,000, and then that would give us our new budget at 21,000. What direct labor costs we would have anticipated direct labor costs to be at 21,000 units, which gives us our 168. And we look down here at our actual direct labor is 168, so we are right on, zero variance. Now we take our variable overhead of $60,000 divided by our 20,000, which gives us 3 times 21,000 gives us our $63,000 in variable manufacturing overhead, and our actual variable overhead was $73,500, which gives us a variance of $10,500 unfavorable because actual costs are higher than budget. And then finally, with our variable operating, take the the variable operating 40,000 divided by the 20,000 gives us 2 times 21,000 gives us 42,000, and then our actual variable operating is 39,500. Okay, and so what we have over here is our $2,500, and of course that's going to be favorable because our actual costs are lower than our budgeted costs. Then we can calculate contribution margin. The way I calculate contribution margin is I take sales minus all my variable costs, and when I do that, I get 147 budget, 139 actual. I subtract the two. 8,000 contribution margin is less than what it should have been. Unfavorable. Okay? And then I can look at my fixed costs. I can say my fixed costs were budgeted to be 80,000 for 20,000 units. Now the question becomes is what should fixed costs have been at 21,000 units? And it's 80. The right answer is 80,000 because they're a fixed cost. They don't change. They should not change as the level of activity changes. They should stay the same. So I'll say my fixed costs and I'll say my fixed overhead, and I would anticipate it to be 80,000, and it was actually 77.5. So my actual fixed costs are lower than what I should have been, 2,500 favorable, and then my fixed operating expenses, 12,000 and 12,000, so there's no variance. And then I can come over here and I can calculate my income from operations, my net NOI, my net operating income, and I can take my contribution minus my 92,000 in fixed costs, gives me 55,000, and then of course we pull in our 49,500 actual income from operations right there, and what I end up seeing is 5,500 unfavorable. So what is this telling you? It's saying that, look, yeah, you actually did have more profit than you thought, but it was due to volume. If you had operated at if you had actually done the budget at 21,000 units, which is what you actually did, you should have made $55,000 at 21,000 units. But you ended up making only 49,500 at 21,000 units, which means you're $5,500 under your budgeted profit, which is going to be unfavorable. So when we controlled for volume, you didn't do as well as it appears. Now, if you look over here and you look at some of the big culprits, direct materials and variable manufacturing overhead, just kind of looking at these, which kind of really contribute to this $5,500 unfavorable variance, it looks like to me that maybe they had a problem with their supplier. It's difficult to say. We're not given enough information, but just because our materials costs and variable overhead would be indirect materials, we could have had a problem with our supplier. Okay? So anyways, reviewing flexible budget performance reports, what we do is we have to have our budgeted level performance the same as our actual. And the way we do that is we put all of our budgeted sales and variable costs on a unit basis and then multiply it times the actual level of output, and then that gives us what the budget should have been. Okay? Let's do some additional problems right over here. Let's look at this number 2. It says right over here, product has a sales price of $20 based on 15,000 unit production level. Variable costs are 12, fixed costs are 6. Using a flexible budget for an actual level of production and sales of 18,000. What is budgeted income? So we'll come over here and we'll say our sales is going to be equal to our $360,000, which is our 18 times our 20, right? And then we say our variable costs, VC, variable expenses, or you could say variable expenses, 12 times 18,000. Remember, variable expenses per unit stay the same. 12 times the 18,000 gives us our 216. Okay. Sales minus our variable expenses gives us contribution margin of 144. Now, what are fixed expenses at 15,000 units? Well, it says at 15,000 units, it's $6 a unit. So that means total fixed expenses at 15,000 units is $90,000. Because 15 times 6 is 90,000. Now, what should fixed expenses be at 18,000? It should be the same, because total fixed costs stay the same. So we say our fixed, okay, is 90,000. So then we have our income from operations, net operating income, equal to $54,000, and that's the right answer. Okay. Now this next one, I'm just going to kind of quickly show you the answer because I don't think it's too hard, especially since we just did that one on the flexible budget performance reports. But basically what I'm asking you here to do is to do a budget for 20,000, 22,000, 24,000, and I put everything on the unit basis. So here's the answer. At 20,000, all we need to do, right, is go 20,000 times the sales price of 11. Yep, gives us our sales. Direct materials of 3 times the 20,000. Direct labor 425 times the 20,000. Variable overhead 50 cents times the 20,000 gives us the 10. Variable selling, which is at 25 cents per unit times the 20, gives us 5,000. You take the 220 minus the total variable selling cost, gives us 60,000 contribution margin. Factory depreciation is 12,000. Supervision is 11,000. That's at 20,000, and since these are fixed, those will be the same at 20, 22, and 24. And then same with admin, those are fixed costs. So I take my 60,000 minus my 12, minus my 11, minus my 9, gives me my 28,000. I repeat the same process for 22 and 24. The variable costs, multiply it times the unit times the output. The fixed costs stay the same because they're fixed. Okay? Some concluding remarks over here with regard to budgets is that the causes of budget variances, the budget may not have been well conceived, conditions could have changed, and this is what we're really trying to isolate. Okay? Management by exception, again, looking at those big significant variances. And again, just some concluding remarks over here is that budgeting is a highly political process, especially in higher education, can be very political. And what I mean by political is not Republican, Democrat. It is talking about people protecting their own departments. It's basically turf battles. That they're looking out for themselves and they're looking out for their own departments to the potential detriment of others in the organization. That's what I mean. So basically, with budgets, you can run into a lot of turf battles. People don't want to give up money in their budgets. Okay? And that's what I mean by political. So that's kind of like what I was talking about over there. I do have some additional problems over here, additional budgeting problems, pages 33 through 39. I'm going to say Canvas. I'm going to post a spreadsheet up on Canvas that details how to do all of these, okay? And it's a pretty good in-depth spreadsheet that says exactly how to get each answer. I'm writing Canvas across the board here, okay? Now, all these, I'm going to post up additional problems, post a spreadsheet on how to solve all these problems, okay? And this is a merchandising problem, okay? That's what I was saying over here with our purchases budget rather than the production budget. It's a merchandising problem, and I will post the solution up on Canvas. Thank you.